Hi, this is Damon King with Chapelwood Financial Services, and the recent market pullback this week certainly was jarring, wasn't it? A little bit unexpected, perhaps. After all, we started the year off this way. We've had a couple of decent quarters of performance, and now it seems here we go all over again. So, what is exactly causing this pullback, and what do we believe the outlook is for the rest of the year and into the future? We'll provide that here in this video, but the first thing that I want to tell you is that we here at Chapelwood Financial are not worried. This pullback does not have us scared at all. We don't like it any more than you do, but we're not scared, and I'll explain why. The S&P 500 this week lost almost 6% of its value. What exactly happened? Well, the simple explanation is rising interest rates. As you know, the Federal Reserve has been slowly raising interest rates over the past couple of years. They've been doing this because our economy has grown considerably in the 10 years since the financial crisis of 2008. It was the right time to go ahead and raise interest rates. In fact, it's the sign of a healthy economy. But when interest rates go up, they don't affect stocks directly, but they do have two indirect effects. First, when interest rates go up, it makes borrowing more expensive. Just as you pay a higher rate when you go buy a car or borrow for a car or a home loan, companies have to pay more to borrow to fund their operations. When they borrow, they take from banks. They also borrow from you when you buy their bonds, and they pay an interest rate to you. If they have to pay higher interest rates, their profit margins shrink, and when that happens, their stock prices tend to go down. The other effect rising interest rates have is that it makes bonds more attractive to investors. When interest rates go up, bond prices go down. If you could go out and buy a safer investment for a cheaper price at a higher rate, you'd probably do it. Now, most people look at bonds as safer than stocks. So we saw a lot of people sell off their stocks, buy bonds. That big sell-off caused stock prices to tumble. That, in a nutshell, is what happened. But there are other things weighing on the minds of investors at this time as well. We have the midterm elections, a lot of uncertainty around those coming up here in the next couple of weeks. There's still the threat of a trade war with China. We've got icy relationships with Russia and North Korea and Turkey. It's just put us into a really foul mood, and all of that conspired to create the pullback that we saw this week. So, what is the long-term prognosis? Is this a major correction with a recession on the horizon, or is this a momentary pullback that represents a buying opportunity? It is true that major stock market corrections in the United States have historically been in and around a major economic downturn. But in this particular case, we do not believe that is true. As I said, we are not concerned. Based on the research that we have conducted and the information that we have from our investing partners, we believe the declines of this past week are still part of a normal correction cycle. Before 2018 even began, we were telling you, expect more volatility. It's not going to be like last year. And we were also telling you to expect single, maybe mid to high single-digit returns in the S&P 500. That's about where we are right now. We still expect to hit that target by the end of the year. History has repeatedly shown us that there is weakness ahead of the midterm elections, and it represents a buying opportunity if you have a reasonable time horizon, say 5 to 10 years or even longer. Something else history has shown us. If you look at the 16 quarters of a 4-year presidential election cycle, the two worst performing quarters of that entire period are the second and third quarters immediately preceding the midterm elections. That's exactly where we're at on the calendar. And check this out. When do you think are the two best performing quarters? The two quarters immediately following the midterm elections, and we're about to hit that here in just a little bit. In fact, since 1946, the S&P 500 has averaged 7.51% in the fourth quarter of the midterm election year and 6.61% in the first quarter of the year immediately following the midterm elections. So if that trend holds true, we've got some pretty decent quarters in front of us. There are other reasons to be optimistic. Corporate earnings growth continues to climb as a result of tax reform. Inflation is growing at a slower rate than previously feared. Economic growth is still very strong, and interest rates, even though they are rising, are still relatively low. All of this leads to one conclusion. In fact, our research strongly suggests that the current market expansion has at least another 12 months left in it. In the midst of this kind of volatility, it can be very scary, and you're very tempted to want to make wholesale changes. It's very important to remember why you are invested the way you are invested. As a client of Chapelwood Financial, your particular portfolio is structured the way it is for a very specific reason, to meet your very specific needs. So long as those needs and those goals and objectives have not changed, there's no need to go out and make wholesale changes to your portfolio. And more importantly, in this current pullback that we're seeing, there is no need to fear. This is Damon King with Chapelwood Financial. Thanks so much for watching.